We are joined now by AlphaOmega Advisors, Peter Cecchini. By the way, he's the former chief market at Cantor Fitzgerald, and he has a new newsletter out that I'd recommend. It's called Check In with Cecchini. Peter, thank you so much for joining us.
Thanks for having me.
Peter, you made headlines the other week with your latest talking about the Portnoy top. I want to talk about what's going on, though, in the economy, in the markets. We have an economy that looks like recovering from the steepest recession, but that might miss the point. What do you think?
Yeah, it's difficult for us to even really fathom the sort of severity of the shock. And it's equally as difficult, I think, to really understand the data as it comes out relative to the quickness of the recovery, meaning we're going to see big down numbers and big up numbers. And putting those things in context is just, as those numbers are as big as they are, it's just been very, very difficult. And I think the even harder part of all of that is to assess within the context of that very severe slowdown in economic activity, what's the impact of fiscal and monetary policy on all of that? It's a very, very difficult variable to assess right now.
Well, you mentioned it's difficult to assess. Then what is an investor to do? How do you even begin to assess it?
Well, we're all doing the best we can, certainly. But one of the things we have to keep in mind and be vigilant about is risk versus reward. And right now, for example, if I look at valuations on pretty much all of the major indices in the United States, if I look at the S&P 500, for example, it's trading around 25 times forward earnings, forward 2020. The Russell is trading at nosebleed multiples, closing in on 100 times 2020 earning estimates. And so really the only way that one can justify from a valuation standpoint, or buying equities at those levels, is to believe that 2020 earnings are going to experience a V-shaped recovery. And I think, frankly, that's far from certain. And given, again, the sort of severity of the shock and the unprecedented nature of it, I think that doesn't really take into account the risk one is taking to own equities versus the reward.
So are you avoiding equities? It's just like a bear market bounce at this point?
Yeah, I think it's somewhat akin to the bear market bounces we've seen over history. It's over time. It's been obviously, it looks more like a V than pretty much anyone we've seen since the one right after the Great Depression. But I do think it's a bear market bounce. I think it's a wait and see. Risk reward is really unfavorable to equity investors here. And I think the next shoe to drop, frankly, is that defaults are going to continue to increase, especially in the high yield and speculative grade loan markets.
Yeah, I was going to ask you what you make of what's going on within the credit markets and what kind of picture that's painting for you. It seems like that might be, in your view, a bit more realistic. What do you make of that?
Yeah, we saw, even high yield credit spreads tightened quite a bit on the announcement of all the stimulus. And I believe high yield spreads tightened to about 420 basis points. And they're now about 520 basis points. And that looks a little bit more realistic to me. But unfortunately, if we're going to see corporate default rates increase, and I think perhaps up to about 10%, I think the high yield market will trade lower, meaning spreads will go wider. So I think there's more pain yet to be felt by high yield companies. And I think that eventually bleeds back into the real economy through slower corporate profits and through payroll reductions.
One of the things I mentioned at the top was your check-in with Cecchini note, and you called it the Portnoy. You even got David Portnoy's attention on Twitter. He was tweeting about it. What would you say to retail investors? We have a lot of retail investors who will be watching this program. What's your message to them, especially folks who recently gotten into the market?
Yeah, the attention the note got was completely unintentional and unintended in almost every way. Really, someone had sent me a tweet, and I just saw a very emotive day trader, and I frankly never heard of him before. And I felt it was somewhat emblematic of the markets more broadly and the emotion and sort of the visceral nature of the way stocks were trading. And I'd previously written about how retail investors had garnered access to the markets much more easily through trading apps like Robinhood. So it wasn't the first time I'd written about it. And I think the flows and the data actually show quite clearly that there's a sort of a new cadre of traders in the retail space that are very important to the way markets are behaving now, perhaps in a way they haven't been since just prior to the blow off top in 2000.
Peter Cecchini, founder of AlphaOmega Advisors, thank you so much for joining me.
Thanks so much.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.